Hey, this is Arthur Hill, Senior Technical Analyst with StockCharts.com. It is Thursday, August 1st, and you're tuned into On Trend. Thanks very much for joining us. So today we're going to take a look at the selling pressure. How strong was it yesterday? We're going to quantify it. We're going to look at some weekly charts for perspective, and we're going to finish with the intermarket arena, bonds, oil, gold, and the dollar. I also have an important announcement. This will be the last On Trend show because we are moving to a new commentary offering. Stay tuned to Arch Charts for developments later in August. And if you have any ideas on the future for the commentary here at Arch Charts, please send an email to arthurh@stockcharts.com or hit me up on Twitter. So we got some pretty strong selling pressure, but how much or how strong was that selling pressure? And to measure that, I'm going to look at two indicators. I'm going to look at AD percent, and I'm going to look at AD volume percent. So AD percent equals advances minus declines divided by total issues. So in the S&P 500 example there, you can see if you have 450 advancers and 50 decliners, that's 450 minus 50, which would be 400 divided by 500, which would be 80%. So you had 90% advancers, 10% decliners, 90 minus 10 is 80%. And so that 80% level is kind of a threshold that shows you extreme buying or selling pressure. Now, if you look at some previous instances, in early June there, you can see we moved above plus 80% for small cap 80% and as mid cap and small cap 80%. So we had what's a 1 day breath thrust, if you will, a double 80% up day in two of the three major index ETFs. And you can see in May, we got a minus 80% down day in all three, and that started that decline there. We got a second one about a week later. So that's what I'm looking for to show extreme selling pressure that could extend for a few weeks. And if we look at what happened yesterday, you can see 80% for the S&P 500 was at minus 65%. That is the most selling pressure, most downside participation since the latter part of May, but it's still not at the minus 80% level, not that intense. And you look at mid caps, they've gone below minus 50% a few times. And small caps actually held up better yesterday as 80% only dipped to minus 33%. So all in all, I would not characterize yesterday as a big down day that could herald an extended correction just yet. I would like to see, or I would have to see, a minus 80% down day in two of these three to suggest that we're going to embark on an extended correction like, say, May. All right, so now we have up volume, down volume percent. And AD percent, advanced decline percent, measures participation because an advance is +1, a decline is -1, regardless of market cap or volume. Now, when we use volume in this case, that pretty much takes into account market cap because the bigger stocks typically have the higher volume levels. So you can see we have up, down volume percent, and that's up volume minus down volume divided by total volume. And that's for each of these three indexes, S&P 500, S&P Mid Cap 400, and S&P Small Cap 600. So if up, down volume percent equals plus 80%, then that means 90% of all volume was up volume. And if it equals minus 80%, that means 90% of all volume was down volume. And so I look for these 1 or 2 day volume thrusts to signal the start of an extended advance or decline. And I usually look for two of these three indexes or AD or up volume, down volume percent indicators to exceed plus 80% or minus 80%. So you can see here in the liftoff there in December, all three moved above plus 80%. And again in early January. So that was like a double liftoff, and that led to an extended advance. Then we got a decline, and we got a downside volume thrust there in the middle of May. And that led to more selling pressure towards the end of May, early June. And that ended with a volume thrust when 2 of the 3 moved above plus 80%. Mid-cap up-down volume percent hit 79.38% or something. It fell just short of the 80% mark. So if we look at the current situation, we can see that we haven't had any strong volume come in after that initial thrust, but the down volume has been limited. So there's, it's neither one. So you go with the last signal, which was the up thrust. But as far as a signal that we're going to move into an extended decline, well, a correction at this point, because a one-day volume thrust is not enough to suggest a bear market. But if 2 of the 3 here move below minus 80%, then that is going to be a negative for the market and could suggest we're going to get that correction like we had in May there in the S&P 500. Now, one more thing to note, look at AD volume or up volume, down volume percent for small caps, minus 9.29%. By far the least weak of the 3. So small caps held up the best yesterday. Now, as you know, here at StockCharts, we calculate and we publish AD percent for the major indexes and the 11 sector SPDRs. And you can chart each one of these. And I have a chart list with all of these that I follow on a regular basis to update my index and sector breadth tables. So for instance, here you can see mid-cap 80%, and there's the plus 80 and minus 80. Yep, I live in Europe, if you happen to hear that classic European siren. But here you can see mid-cap 80%. This is the 10-day EMA. And if it goes below minus 30%, that's a downside breadth thrust, and that would be bearish. But you can see the last signal was a bullish breadth thrust. Actually, it was back here in January. So we're still on a bull signal for mid-cap 80% as far as that 10-day EMA is concerned. Now, what I like to do is when I have all of these indicators in a chart list, I'm going to go View List As, and I'm going to choose Summary. All right, once I choose Summary, I can see all the values and I can sort. So now I'm sorting by name here. And so you can see I've got the 3 major indexes at the top there. And also you can see that large caps led the way down yesterday with minus 65% for 80%, followed by mid caps, and small caps held up better. And I could also sort this by the close. And that will show me where the strongest selling pressure was yesterday. And it was in consumer staples. So 80% moved below minus 80% in consumer staples and in healthcare. So healthcare had a lot of selling pressure, and that's not a good sign because that means that triangle breakout I pointed out where we're testing it could fail, and I'll update that in a minute. Industrials, a lot of selling pressure. Communication services, below 70%. Materials, technology, and there's kind of your benchmark, the S&P 500 at 65, minus 65%. And then the things that held up best were energy, consumer discretionary, utilities, REITs, and finance, but not by much. So now let's look at some weekly charts for the major index ETFs. But first, when I was looking at my chart list, I came through this chart. And I do not think the S&P 500, the U.S., is an island, but clearly it's the strongest index, or one of the strongest indexes in the world. The Australian All Ordinary Index is not on this chart, but it is hitting a new 52-week high, and it is also one of the strongest in the world. But if you look here, there we have the S&P 500, and you can see a higher high from January to September, and another higher high from September to April, and another higher high from April to July. And then if I scroll down a little bit to put these other ones into perspective, there is the German DAX, and it's got lower highs there. So it is underperforming, and it's still got lower highs. There's the Shanghai Composite. It's underperforming. There's the United Kingdom Stock Index. We don't have the FTSE anymore. But it's having a pretty good, go here over the last few months, but it's still below the spring high. And then the Nikkei is not doing very good. It's well below that September-October high. So, these four indexes are not doing very good. The U.S. is still doing okay. Now, if we just focus on the U.S. and we use SPY for our focus, and I haven't showed this chart in a while, but, I don't use angled trend lines very often, and I don't like to use them as support or resistance. The angle of the trend line, the steepness of the angle, basically defines the rate of change. All right, the steeper it is, the sharper, the higher the rate of change, and the steeper the advance. And what we have potentially here is a broadening pattern. And broadening patterns are typically bearish reversal patterns, but they're very rare, and a lot of them don't work out. So, this is a bit of faith-based technical analysis. But what I do see is a 5-week stall and a clear support level to watch first. So what we see here is you can see these moves just keep getting bigger. Down 12%, up 15%, down 20%, and now up 29.7%. And you have a lower low and a higher high. So this market is a bit out of control, if you will. The trend is up, but it's after that lower low. It's after a 52-week low. So I don't consider this resistance necessarily, but there's clearly a support level established over the last 5 weeks. And if you break below that, that would reverse the short-term uptrend, and then we would have to watch out for a bigger trend reversal. I'll, of course, keep an eye on the index and sector breadth charts for my signals, as well as the 200-day cross. Now, what I've got here in the indicator window is the PPO 440, 0. And when you put 0 as that last parameter, it gives you the histogram format for the PPO. So this is the difference between the 4-week EMA and the 40-week EMA. It's similar to the 4-week SMA and 40-week SMA, or 20-day SMA, 200-day SMA, but not exact, of course. But as long as it's positive, the cup is half full. But if it moves negative, then the cup will clearly be half empty then. So the S&P 500 right now is doing fine, but I would watch out if we break this support level around, call it 294, that would be a short-term negative. So here is QQQ, and we also have a short-term support level to watch going forward for QQQ. I put on the Fibonacci retracements, and they're not magical, but when you get a pullback into one of these retracement zones, like the 50 to 62% retracement, and you get this kind of a reversal, that is something to watch out for. And you can see that this decline retraced around 50%, and then you got the bullish engulfing, weekly bullish engulfing, and a breakout there. So that's a signal worth noting. Now we've been consolidating kind of for 5 weeks, and if we break that support level, so if SPY and QQQ break their support levels, that argues for some sort of a corrective mode. And the indicator window shows the QQQ SPY ratio, and you can see QQQ is outperforming in 2017 and the first half of 2018, and it's been performing in line. And that's just fine with me. As long as it's performing in line and the S&P 500 is hitting new highs, QQQ is worth pursuing. It's when it's underperforming that you say, well, I have a better choice. And that is the truth that we have with mid caps and small caps, which I'm going to show next. All right, so here is MDY. And, the argument that relative weakness in mid caps or small caps is a negative for the argument, broader market, just doesn't hold water for me. Because, look at mid caps. They've pretty much been lagging since the latter part of 2016 as that price relative moves continuously lower. And yet you have the S&P 500 hitting new highs. So, that doesn't mean the market's going to fall apart when these underperform. So if we look at this, we got to say, okay, if you had a choice between large caps and mid caps, you'd choose large caps, clearly. Now, what we're seeing on the MDY chart is, first of all, you have a lower low. So you broke the support level. You've come back up to this prior high. And now we have what could be a potential double top working here. And if we break that support level there, and that coincides with support I just showed you on SPY and QQQ. So now we have a third one to watch. If all three of these break support, that's going to be a negative. So that's what to watch out for. Maybe it's a double top, but I would rather take my signal with the short-term support break around 352 or whatever than a break below 328. All right. I think it's too late then. I mean, you got to kind of be a little bit anticipatory, especially with a lower high coming in. And then we look at the Russell 2000 ETF, small caps. This one, it has bouts of outperformance. You can see there in January to June 2018, it outperformed the Russell 2000, but it's been underperforming since the summer. And since it's been underperforming, even though it's been underperforming, SPY has hit new highs. So it hasn't affected large caps. It's affected small caps. Small caps have affected small caps. Boy, that's profound. But what we have here is basically lower highs. So you can see this is a lower high and now a potential lower high here. I showed a flag breakout on Tuesday. The flag breakout is holding, but you can see there's that same support level. And you can also see there's that lower low. So we got a lower high, a lower low, and a potential lower high here. And I see what the bulls see with the flag breakout, but I think we also have to say, okay, what do the bears see? Okay, what am I missing here? And, what it could be is, maybe there's some sort of a wedge here. But either way, if you break support here with another lower high, and that's after the lower low here, that's pretty negative for small caps. So if all four of these break short-term support, I would be tempted to just move aside until things clear up. So just quickly, I'll update the index breadth table. It is still bullish. There is no change. You can see that these indicators have been net bullish, which means the majority are on active bullish signals since February 15th, and currently 7 of the 9 are bullish. The only index that is net bearish is the small cap S&P 600. Mid caps and large caps are still in bull mode. And if we look at the sector table, there is no change there either. Keep in mind that this covers the sectors in the S&P 500 only. That's what these sector SPDRs are based on. And so just looking at this table here, you can see the only sector that is net bearish is energy, and it's been net bearish since May, by far the weakest sector. Consumer discretionary has one bearish signal, but the rest, 30 of 33 signals, are bullish, actively bullish. And you can see that means that 10 of the 11 sectors are net bullish, and the sum of the weightings is plus 88.82%. So I wouldn't become concerned with the market overall unless this number starts dipping below 50% or something. But let's cross that bridge when and if it gets here. So looking at the big 6 sectors, which account for 78% of the S&P 500, we can see technology clearly doing fine. I've got SPY down below for reference there, and you can see that SPY has the higher highs there, and so does XLK. So it's clearly keeping pace. Now, that doesn't mean we can't get a correction of some sort. So, we could correct into that 75 area and still be in a normal or healthy uptrend. Consumer discretionary looks pretty much the same. You can see the breakouts there, first in December, and then there is the one in June. and then we have higher highs. So it is keeping pace with the S&P 500, but this one could also correct here back to that 115, 117 area possibly. Now we get to the weaker ones. Finance is still one of the weaker ones. I know it had a leading gain in June and July here with that big move, but it's still below that August-September high. It's still below the January 2018 high. So, it's gone nowhere basically since February 2018. You had the big decline, 24%, a big advance, 26%, and you're back to where you were 18 months ago. So finance, yeah, it's doing okay short term, but longer term, it's not that great. Same with industrials. As a sector, it's not doing that great over the last 18 months, because there you can see where it is now, 77.82. And if I draw my big arrow, it goes back to January 2018. So we're back at those levels from 18 months ago. We can also see a potential double top brewing there with two highs at equal levels. And there's that same support zone I showed in the major index charts. If we break below 76, that would be a negative for industrials and the market. Communications, yeah, getting a big lift from Google and Facebook. So it's right back near that high. This blue line shows you when they had the reformatting of the sectors. This is the new alignment for the communications sector. And again, you had the pullback there and the breakout. And we have a support at 49. So that's another support level to watch. And I'll be monitoring these short-term support levels going forward. Here is healthcare. And yeah, it's gone nowhere as well. There you can see we're currently at 91.41. And that's pretty much where we were at the end of January 2018. Now we still have this triangle breakout working, and we have the throwback. So we're at a potential support zone to watch for a breakout. But if the market, turns soft, that breakout might not happen in healthcare. And we had a lot of selling pressure in healthcare on Wednesday, and that's a concern too. And then consumer staples, one of the leading sectors since December, because it hit a new high this week, intraday. It came off that high. It could be due for a correction as well, but it's one of the leaders. So you have technology, consumer discretionary, and staples as the clear leaders. There's energy, the big laggard. You can see it hit the reversal alert zone there in April and reversed, and then it bounced and hit another similar reversal alert zone. And so I think it's still weak, and I would expect it to continue lower. And I've got oil coming up, which also looks similarly weak. Utilities, they're coming off their high, but still in an uptrend, so nothing weak there. And REITs are consolidating with a little triangle coming off their high, but no real weakness yet. They're still, they're in the top 5. Utilities and REITs would be the next 2 as far as the top sectors are concerned from a longer term perspective. So now we're going to turn to the intermarket arena. We're going to look at bonds as well as gold, oil, and the dollar. But first of all, I've got some ratio charts, and I'm not a huge fan of ratio charts overall, but they can give you an idea of when one asset is leading the other, one is lagging the other. And what I've got here is stocks relative to bonds. This is the IEF, the SPY IEF ratio. There you can see the symbol there. And basically you have a risk-on environment when stocks are outperforming bonds, as they did here from March until September. And then you have risk-off when stocks underperform bonds, as they did October, November, December. And we went to some risk-on. But you can see we didn't get back near that high, so we have a potential lower high. And we have another lower high here in July. So, SPY is hitting new highs, but this ratio is not. And it might be rolling over and turning down. Of course, the big reason for the move lower yesterday is the combination. You got a surge in bonds and you got a decline in stocks. So if we look at the SPY TLT ratio, we can see a similar pattern. We've got some risk off working because stocks are not outperforming bonds. You're making a better return in bonds over the last 10 months or so. Then if we scroll down a little bit, I've got junk bonds relative to treasury bonds here. That's the J&K-IEF ratio. And you can see that it had a breakdown there in May. It bounced back, but is not doing that great the last month and a half or so and could be turning down. So junk bonds, which carry above average risk, are not outperforming treasuries. And so that's another negative sign in the credit markets that could be coming back to affect the stock market. So here is the TLT chart, and it has been bullish since the breakouts. It got the first breakout there in the latter part of 2018, a little bit of a flag in early 2019, and another breakout and a sharp move higher, and it's above the rising 40-week moving averages, the weekly chart. And there you can see the 30-year yield is declining. It's a mirror image. So yields are moving lower, bonds are moving higher. You look at IEF, we got a similar picture there with the surge and breakouts, consolidation, another breakout, and a sharp move higher. And look at the 10-year. It's right around 2%, the lowest level since 2017, the summer. Then we look at gold. Gold moved sharply higher, but it's turned a bit volatile as it digests these gains. I don't know what to do with gold at this point. The last signal was this wedge breakout, and it turned out to be a dandy. And you got the big surge, but you can see now we've turned volatile, and gold is not sure where it wants to go. So I would just wait for the next setup to materialize. And then oil looks a bit like XLE. Now you can see that we got a big move up in oil this week, but overall, we had a reversal at the first reversal alert zone in April and a sharp decline. And then we got a bounce and we got another reversal at the smaller reversal alert zone just in the low 60s there with that sharp decline. So I still think that is the more active signal and the longer term downtrend prevails. So I would look for lower prices in oil. And then if you look at the dollar moved to a new high. So the Fed cuts rates, treasury yields fall, and the dollar jumps. Go figure. But it's because of the euro, because the euro hit a multi-month low. It's down near 105. That's the lowest level it's been since the May period of 2017. And it's 57% of the dollar index. So as long as the euro is falling, the dollar index should rise. And the yen, I have no clue. It's just been in a 2-year trading range. The Arts Charts commentary is available to all. Click on the Articles tab at the top of every web page. And then from the All Stock Charts blogs drop down, click on Arts Charts. So that concludes this edition of On Trend. Thanks very much for tuning in and have a great day.
This is a little info demo to show you how to put a solid line or something like that on the top of an indicator that you might already have. When you scroll down here, it was on the SCTR line, but I want an overlay of a horizontal line. And in this case, I can set it up so I put the line at 75 on the indicator SCTR, and using the colon symbol and then the word blue, it'll put a blue line up there for me like this. So if you're looking to do overlays, just those simple little tools, but use the colon command to help color it.